Hi everyone, my name is Kathleen Rockney and I'm going to be talking about the magic of the Schedule C for those of you who live in the US and you file your taxes every year. The magic of the Schedule C may allow you to make decisions on increasing your income differently than you would have if you hadn't thought about these points. Now, a little bit of background about myself. I'm in my mid-60s. And both of my parents lived through the Depression. They were starving, their families were very poor, and that mindset was brought into their upbringing of me. So I was told from the very beginning, find a job with a really good company that's going to be sticking around for at least 50, 60 years, stay with the company, and earn your income there. Well, for someone with a Depression era mindset, that is magical because they were quite often unemployed for months. But as you're going to see with the magic of the Schedule C, that might not be the best way to bring in extra income. So let's talk about a scenario that is hypothetical, but may be common to many of you watching this, okay? Maybe you are a family of 4. Husband, wife, 2 kids. At this time in your life, the husband is making $38,000, the wife is staying home with the kids. But there comes a time when being efficient with your budget is just not cutting it anymore. So there's a decision that the wife is now going to go work full time. She has the same earning power. So the husband was bringing in $38,000 a year. The wife is going to be bringing in $38,000 a year as an employee of someone else. That is quite often the decision that people make. So we're going to talk about a couple of things about this. But first, let's look at what's on the screen. I want you to understand that the tax tables of the IRS are in tiers. So there's a very initial tier where if you make a very low income, there's no tax owed. Then the next tier, and I don't know what it is because they didn't have it online, but let's say the next tier is $20,000 to $29,000. There's a small amount that you are going to owe, but all of your earnings below $20,000 are still free. If you look at this tax table, this was one that I was able to find. If you make at least $100,000, which wouldn't that be nice, but not over $168,400, and you are married, filing jointly, your tax rate is 22% for that sliver. What you made under that is at a lesser tax rate. If you go above that, as you can see, then that sliver will be 24%. The next sliver is 32%. It is easy to pop into a higher tax bracket as your income increases as an employee. Now, as many of you know also, there are not many deductions anymore for employees. If you happen to be an employee for a company that has a business account and you can have business expenses and get reimbursed, that's great. But you yourself cannot write off part of your income with business expenses anymore. And this, some of this is recent and some of it is really tragic. Teachers are limited to an extremely low amount nowadays. And I was just talking with the teacher today who said that she spends about $10,000 a year of her own money. And now all of that is just out of her pocket and she's not able to use it as a deduction. She is an employee of her state school board. So this is why there's magic to the Schedule C. Now let's see if I can scroll and I can show you exactly what happens to that husband and wife at $38,000 and then the wife starts earning it. Let's see if I can get this down to page 7. Okay, page 7. $38,000. If the husband is working by himself, wife is staying at home. And if you scroll up, you see that the third from the end column is for married filing jointly. Okay, $38,000. So the husband, if that's the only income, and let's say that's their adjusted gross income, they're going to owe $4,175. Now, as an employee, hopefully they've had that deducted. If the wife then joins the husband, it is not going to just be $8,300 because they go into another tax bracket. So he was at 38,000. Let's see what 76,000 looks like. There's 76,000. It's up to 8,700. You can see that the wife joining the workforce has not only increased their expenses, such as commuting to and from, gasoline, wear and tear on the cars, what she needs to purchase in terms of lunches for herself, possibly business attire. None of that is deductible. So let's look at what the 1040, the US 1040 tells us and gives us some hints of what can be done that could be different. And when I got this, and literally I was indoctrinated that you work for a company, you stay with the company till you retire. We did not have entrepreneurs in my family, so this was a whole new concept. So let's go to that 1040. Here's the 1040. The 1040 in 2019 has been shortened. You still deduct your dependents, which is great. And everything on this of the traditional items have to be positive. So the husband and wife, if they're both each earning $38,000 each from an employer, their W-2 form, which will now be $76,000, will show up in that line 1. If they have dividends and they have bank interest, those show up as positive numbers. If they get an IRA distribution and early withdrawal, let's say they're younger, that's a positive amount. That is adding to their income. If one of them ends up hitting 65 in their Social Security benefits, that is an addition. Look at line 6, capital gain or loss. Now that is when you have the gain or loss of a property. Great that you could possibly post a loss there, but chances are you invested a ton and now you really have lost that money. Let's look at line 7A. Other incomes from Schedule 1, line 9. And then 8A is adjustments to income from Schedule 1, line 22. Now in their wisdom, they decided to take a hunk of the 1040 first page and put it into a Schedule 1. So you have to fill out the Schedule 1 and then you fold it into here. But it is in the Schedule 1 where you can have a negative number or much lower than what you actually earned. So let's look at what a Schedule 1 is. Let's look at Schedule 1. Schedule 1. Now, I hope, again, if you feel you're not math competent, remember, this is not about teaching you how to fill this out. It's teaching you the magic of it. So whether you take it to a tax preparer, H&R Block, a CPA that you know, or you do TurboTax, they will know where to put your information. I'm just letting you know there's a whole window of opportunity when you start looking at a Schedule C. So Schedule 1 now, just to confuse us all, this is brand new schedule. It lists the additional income that used to be on the front of the 1040. So you have maybe a tax refund from your state that you received last year. You put that in, that's in line 1, that is a positive number. Alimony received, positive number. Look at line 3. This is where the magic starts. Line 3, business income or loss. Attach Schedule C. Now, let's talk about this. Schedule C is about being a small business owner. There's two ways of being a small business owner. One is having a small business in a small office. You've got office overhead. You may have an employee if you decide to have a part-time secretary, but it's a small business. And it's normal in your first couple of years that your expenses in that small business exceed your income. That takes a small business in an office, takes some equity, it takes some investment. What if you're a small business owner in a home business? The house is already built, or your apartment, wherever you're working out of. You're using your talents for a small business. Much less investment, and you still, within those first 2 years, it's totally okay for you to have a loss. It is okay to have a negative number in your Schedule C. Let's break that down one more piece. In your little home office, you could be an architect that works by project, and hopefully you have projects that are laid out in a way that you always have some income. Maybe you're an interior decorator. You work out of your home. You even have clients come to your home sometimes to look at swatches of fabric or something. You're going to be able to do a Schedule C, and it is by project. If you start to look at home businesses, and this is my experience, and what I saw when many years ago I was a tax advisor for the IRS. I worked on the taxes, so I didn't advise people, but I was coding them. And this is when I first saw the magic of the Schedule C. If your home business is something more in direct sales, then you're working out of your home, so you have minimal initial investment. Your home or your apartment's already there. You've got the investment of that direct sale. And it's not by project, because in many direct sale companies now, you get customers who are happy and satisfied, and they order over and over and over again. This is the ideal. But any kind of sole proprietor can use the Schedule C. So in the Schedule 1, you see that there are other places to add loss. Line 6 is farm income or loss. Well, not many of us own farms. In my personal business history, I have never owned a farm. I've never owned a rental property. That takes an investment. I always had just my W-2 earnings, and then I had deductions for owning a home. I do own a small timeshare, but I don't have this wide variety of investments. So the Schedule C magic really, really appealed to me. Now, part 2 goes into educator expenses, and I am so sorry, teachers, but there's not much there anymore. You may want to look at a home business. And teachers sometimes make the best home business owners because they are educators. And educators sell more than salespeople. So the Schedule 1 is going to pull in what the Schedule C is. So you ready to look at what Schedule C is? Woo-hoo. Schedule C magic. Let me grab, my cheat sheet. Okay, we're going to go over here. We're going to go for Schedule C. Schedule C, Form 1040, profit or loss from a business, sole proprietor. Your business name, if you are a home business owner in a direct sale company, is just your name. And it says if there's no separate business name, leave it blank. You don't have to have an employer ID, just use your social security number. Okay, this is one thing I know when I was helping in coding tax forms that were coming in to the IRS, and this is back in the 70s. But I know this. Honesty is the best policy, and I'm going to tell you this. You've got deductions that are going to be powerful on a Schedule C. Be honest. The best place to be brutally honest is in the income part. So many times, as a distributor of a direct sale line of products, you get commissions when people order from the company and their accounts are linked to you. You also get retail sales when you purchase the product, sell to someone at a profit. The company, chances are, is only tracking your commissions. You could cheat, and you could decide that, well, I'm just not going to tell them about those retail sales where I bought the product, I sold at a profit, and that profit helped me pay off what I bought, and I'm going to pocket the rest. Do not do that, because if you ever get audited, they like the fact that you are showing income on your Schedule C beyond what they knew about. Take that in, because it may not have to be much. In my line of work as a distributor of a wellness company's line of products, most of my income is from commissions because I've linked my customer accounts to my account. That comes in as a 1099 miscellaneous. But I've got friends and neighbors who will come over, and I usually keep about an extra month of inventory of my favorite products. And they'll say, oh, I need some vitamin D today. Or, oh, do you have some of that Booster C? And I'll say, yep, I do. I have made a business decision that if someone is purchasing from me, I'm going to sell it to them at retail. So yes, I'm going to make a little profit. I fill out a little receipt for them, and it shows just what they're purchasing for. And then after they've gone, the copy of the receipt, I put on what my cost had been. So there's a section on the Schedule C on income. Cost of goods sold. In a typical year on line 4, I may put that I bought $300, $400 worth of products that did end up then being sold. They were going to be my personal consumption, but they ended up getting sold. So I put that, let's say I put $400. And then my gross receipts, line 1, were $500 because I made a $100 profit from those little sales throughout the year. So there's a $100 profit that the IRS didn't know about. So the gross profit is subtracting my cost of goods sold, my $400 that I invested in these products, from the actual sale of $500, and my gross profit is an extra $100. That will be added to my Schedule C, income and expenses. And the IRS loves that. Please put that on. And I'm saying this out of honesty and integrity, but also because it will serve you down the line if they ever ask for stuff. Okay, now let's look at this bulk of the Schedule C, because this is where it gets exciting. I'm going to use my business as an example. Advertising, line 8. Let me give you ideas of things that can be done for advertising. Polo shirt that has the logo of your company. Exercise tank top that has the logo of your company. You are using and wearing that polo shirt. You are using and wearing that exercise tank top, but it can be put into advertising because you are a walking billboard. If you are on Facebook and you have a Facebook business page and you boost posts occasionally for $5 or $10 to try to get more followers, that is advertising. And you are 100% putting that in. Okay, say you are a part of LinkedIn, you've put your resume down and you upgraded it to that LinkedIn monthly. So you can get a little bit more information, you can see more people's profiles, and you can see who may be following you. That entire LinkedIn expense is advertising. You're advertising yourself. If you have a domain name that is your name or the name of your home business company, owning that domain name is advertising. And having that website is advertising. If you buy products from your company, specifically not to consume, but to hand out as samples, That is where I put that in as advertising. Now I'm going to make another caution. I'm not a CPA and I am not a tax lawyer, but I was a tax examiner. I'd said before advisor, but it was tax examiner. That was my actual title. And as a tax examiner, I could see legitimate places to put these things. But if you are working with someone else and they have a better category for you to put these items in, do it. Domain names in general that you may own that pertain to your business and you're keeping them fresh. You're always refreshing them, renewing them. I put that in advertising. Car and truck expenses. As an employee of someone else, unless you have a business account with your employer and you're getting reimbursed, you are not able to deduct commuting to and from your work. But guess what? You can deduct all of the expenses commuting to and from business appointments from your home, which is your home base. And there's another section to do that. But just know now, if a small portion of the use of your car, and for me it's usually about 15% because I do most of my business at my desk. If 15% of my car can be used as a deduction on a Schedule C, that includes car payments when I had them, 15% of my car payments, 15% of my car insurance, 15% of my new tires that I bought, 15% of car washes, 15% of AAA annual dues, 15% of all my repairs. That sliver is deductible. It's not deductible when you're an employee of someone else. Okay, let's pop down to something else that's kind of interesting because remember the Schedule C is also for people that own a little office, not just home business people. So some of this doesn't pertain. But this number, line 16, interest, other, 16B. If you have a dedicated credit card for your business, you either open it up for your business or at this point on, it is for your business and you paid off the previous. Any interest that might accrue because you can't, for a few months, can't pay it off completely at the end of each month, that interest, credit card interest, is allowable. It's not allowable as an employee. It's not allowable as a citizen of the United States. Credit card interest is no longer deductible. Used to be many years ago, but it's not. Okay, now we're getting to the meat of it. And again, this is all about honesty. Line 18, office expenses. Let me just give you some ideas of what you can deduct if you have a home business, sole proprietor, and let's just say you've picked something that is a consumable product, you're doing direct sales. Your computer that you use for your business, which I highly recommend you have a dedicated computer, laptop, whatever, and you have another laptop, desktop, iPad for home. That dedicated computer. A new printer, if it's primarily used for business. Printer ink. Calendar that you buy annually. Stationery that you use for your business. In my particular business, we've got a back office called the Hub, and you get your best reports when you pay $19.95 a month for that. That's an office expense. You get to deduct it completely. Internet service. How can you not do a home-based business without internet service? If you feel like in your home, only a section of your internet service is for your business because there is a significant amount of internet service used for your kids' homework or whatever, figure out what that is. Make a good, legitimate guess, and that's what you can deduct. When you go to actual home office expenses, and I won't cover that today, but when you go to the home office expense form, you will be able to deduct utilities and quite a few other things. So let me just kind of talk that through right now, even though we're not going to cover that form. If you rent an apartment or a condo, and a significant section of it is your home office, it may be that your dining room has been turned into the home office, or a spare bedroom, or a partitioned off part of any other part of that, where it's clearly your home office. And you may or may not see clients there, and you may or may not see them in the home office, but they come in. One way or another, home office is then a legitimate expense. So that square footage portion of where you live is now your percent of deductions you could never deduct as an employee of someone else. A portion of your utilities, a portion of your landline phone. You own your house and you redo your roof, that small percentage of the cost of the roof. You've got a window in your office, you have the whole house re-windowed. The window in your office, deductible. New carpeting in your home office, deductible. Paint, you paint the house, what's painted inside the home office, deductible. The annual maintenance of your furnace and air conditioning, that small portion, deductible. Your plumbing, because every home office is going to have a restroom nearby and a kitchen. A portion of a plumbing repair is deductible. So that could get really crazy. And also, it's my understanding, if it has not yet changed, that when you rent, that portion of your rent is also deductible. As a homeowner, that portion of my mortgage interest and my homeowners association and my home fire and earthquake insurance is that portion of it. And for me, it's about 10% of my house is my home office. That is deductible. These are all expenses you're paying for anyway. Now, they're going to knock down your income level to make that $38,000 that you made it as an employee. And let's say 2 years down the road in your home business, you're making $38,000. I can guarantee you with all of these deductions, you're down to maybe $12,000 or less. Now let's just go to another part of this. Repairs and maintenance, this little section from 20 and 21 is when you are actually renting an office somewhere else. Okay, travel and meals. How many meals could you have with a girlfriend or with someone who's a potential customer and they're a friend? You talk briefly about your business and you can deduct that meal. 50% of that meal, whether you're traveling or you're in your own city, is deductible. Travel expense. In my business, we go to conventions. That convention is fully deductible. All of the airfare, Uber to and from the airport, the entire hotel bill is deductible. So these are expenses that I put out, but I'm getting fully reimbursed for them. And then if I buy logo wear while I'm at that convention, well, guess what? Logo wear goes up in advertising. And my meals, if I was still at home and not working, I'd be eating. Well, now those meals while I'm traveling, half, 50% allowable, is deductible. So this starts getting really, really powerful. Now, you scroll down, and there's line 28, total expenses, and line 7 is gross income, because it includes other income. And line 31, net profit or loss. And you can have losses in your business legitimately. If you have a dedicated credit card, if you have a dedicated checking account or checking sub account for your business, you are with the intention of earning money. You have customers that are buying regularly, either on their own or through you. You are showing yourself as being a business owner. If you keep a diary, and as much as I love the computer, and that was my bachelor's degree, my diary is my paper calendar. So having those forms of information, and then what I do is I take my calendar and all of my receipts and I put them into a ledger at the end of the year. All of this is showing that you have a business that you're running. And of course, choose a business that you feel is going to be around again for another 20, 30, 40 years. So now the Schedule C sends you back over to Schedule 1 to put it there. Then Schedule 1 adds your profit or loss of your business to maybe your tax refund, any alimony, some other possible income that are personal, and that goes over to your 1040 front page. So when you are a family or a single person and you're looking for extra income, realize that getting a second job is not going to give you additional deductions. It is going to probably pop you into a higher tier. You're going to spend more and give more to Uncle Sam because you are an employee of someone else. But if you take that same energy and that same desire and that same drive and say, let me invest, and in a typical legitimate home business, between $200 to $1,500 is a fair investment of product and maybe some initial training to get set up in a home business so that you can take expenses that you already have and knock them against the income of that home business to bring down your income. Because what's the name of the game with the IRS? Your income, that final adjusted gross income, is what's going to go to that tax table to determine what you owe the IRS. And you deserve to pay only your fair share. Now, I hope this magic that I feel about the Schedule C has piqued your interest. And I hope looking at the schedules didn't freak you out. Again, my name is Kathleen Rockney, and I went from the child of Depression era parents who drilled into my brain that I should be an employee of someone else. And I got to a place where I could say no to that corporate job and say yes to a home business that I have now been in for 25 years. And it is a blessing to be a part of this community. Thank you, everyone. And please put questions and comments below. And I hope to talk with you again soon. Best of luck in your desire and goal of increasing your income, which I love to call abundance.